Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to do an update of my State of the Market series. Look at the charts kind of like once and for all, see what's going on at this point in time. We've known for the last couple of weeks that the market internally has deteriorated. Okay, the quality of our trading ideas had dropped. The quantity of our trading ideas have dropped. You know, when the market is really healthy, I can look at 500 charts and it's hard to narrow a list because there's so many good ones. When the market starts to deteriorate, I go look at even more charts and it's kind of hard to find a lot. There's always going to be some good charts out there, and we've gotten some of those, but there's a lot less good charts, which has been the case. So just the fact that that look underneath the hood revealed less good trading ideas was a warning. The internals deteriorated, advanced decline line, stocks above certain moving averages, the high low on various look back periods all have declined over the last 2 to 3 weeks. And then we saw a lot of stocks start giving stuff back. We went through a period where stuff would move, it would pause, it would pull back a little bit, and then it would move again. And then we're like in a period now where stuff would move, it would pause, and then it would just drop and give it all back. So there was the nature and character of the market had changed. So in this video, I'm going to just go over the couple index charts and then go through some breadth readings just to kind of gauge, exactly where we are here. All right. So here is the S&P 500 monthly chart. You can see nice rally here. Off the COVID low, got a cup and handle pattern over 2022, 2023, and then a fantastic rally 2024. That's COVID, that's tariffs, and now we have, a nice 3-month win streak here. And then we pulled back just at the end of last week. Just want to point something out. Even in an uptrend, you can get a couple down months. So you look at over here off COVID, we had 5 up months, then we had 2 down months, and then it was off to the races again. These candles over here, these red candles, are 350 to 400 points at a time when the S&P was in the mid 3000s. Okay, so if we just had a couple of similar candles here, we're definitely going to drop 600-700 points. It's not a big deal. It's pretty much, if you look at this, you probably wouldn't say anything out of the ordinary happened within this channel. So if we have a similar something happen here, we can certainly go down and test 6,000, which is the 10-month moving average. Even going a little bit below that would not be out of the ordinary. So my point is the trend is solidly up overall, but we can certainly have a month or a period of time off where we do some backing and filling and still maintain the uptrend. All right, here's the weekly chart going back to middle of 2022. Just want to point out nice support there from the 21. The 21 EMA is the orange line. Support there from the 21. Support there from the 21. And then we finally took out the 21 and the market collapsed. So getting a pullback to the 21, which is right here, is not that out of the ordinary. Within an uptrend, you often will, if you can see this, will ride the 8 up and then get a dip to the 21, ride the 8 up, get a dip to the 21, got another dip to the 21. So we rode the 8 up here, dip to the 21. It's pretty normal stuff, okay? The market's not going to just go in a straight line up. So over here, we've ridden the 8 up. So if we get a flush down to the 21, that's about 6,000 right now. That's normal stuff, okay? In the near term, that's painful, especially if you're sitting on some positions. That would be another 240 points from here. But overall, that's no big deal. That's normal stuff. Ride the 8 up, flush down to the 21, repeat. All right, let's look at some indicators, some breadth readings, So here's S&P 500 versus the NYSE, the 5-day moving average of the NYSE AD line. Okay, so advanced decline line. Very obvious divergence formed here. Market was pressing up and up and up. S&P and NASDAQ hitting new highs, new all-time highs, pretty much every other day or so. Sometimes we get multiple days in a row. Other days we get, a couple days off. But market kept pressing higher and higher. Less and less stocks above there, less day to day, less and less stocks were advancing versus declining. So we got a negative divergence here, internal pressure building, and then all at once it just kind of got released. Now we have the lowest level since back here in May. It's not a big deal. You can get these flushes down. Most important is how it acts after this. Does it recover or does it kind of linger below zero? Okay, it's just something to keep an eye on. But this told us, like, you could play the upside because the trend was up and stocks were moving. But in the back of your mind, you're thinking, hey, internal pressure is building and this isn't going to last forever. All right, so here's same thing, except we're using, this is the 10-day moving average, 20-day moving average, and 50-day moving average of the AD line. Divergence here with the 10. Not really, slight divergence with the 20, not a big one, and then a very obvious divergence with the 50, and then all three of them fell to their lowest levels in a couple months. Okay, so normal stuff. Market moves up here. We get some decent prints there, and there. Market moves sideways and then presses forward, and participation is much less. It's a warning that, not everything is on board with the most recent rally, and you got to look for a pullback after that. Doesn't mean we're going to have one of these. It just means in the near term, we're going to probably do some backing and filling, some sideways movement. The market, the charts got to reset themselves. So here is the S&P 500 versus the 10-day moving average of advancers versus total stocks. This is kind of spin off of the Zweig breadth thrust indicator, where he looks at the 10-day of advancers versus total stocks and looks at some readings here. But same divergence here, obviously, because we're dealing with the same data. That last move up just wasn't really supported, and now we've dropped to the lowest level since April. So we knew it was coming. We knew internal pressure was building. It could have lasted 2 or 3 days less. It could have lasted a week later. We just don't know, but we did know that internal pressure was building and the market was going to come down. So you don't know when, so you put a stop in place, pull back on your trading a little bit, okay, restrict yourself to only trading the best setups rather than every setup, and you move forward. All right, here is the S&P 500 versus the NYSE advanced decline volume data. Okay, so the advanced decline line lets all stocks talk equally. It doesn't matter if you're Apple or Microsoft or some small company, you get an equal vote with the AD line. With the AD volume line, obviously the big volume stocks have more say-so. And, yes, there's some small companies that don't really matter that have a lot of volume, but for the most part, the bigger stocks tend to have the bigger volume. So the reading here was pretty much the same. Divergence here on the 10-day, divergence here on the 50-day. No divergence on the 20-day, but you can see that all it took was like 2 bad days, and boom, all of them dropped hard, breaking below previous lows. All of them well below zero, or I should say just below. The 10 and the 20 are below zero, well below zero. The 50 is not. But just it's a warning. If you don't follow these, like, put them in your watch list. Like, these are indicators that you should follow on a regular basis. They kind of give you an idea of like if a move is supported or not. All right, so here is the S&P 500 up top versus the 1 month high low. Okay, so when the market's moving up, you get a lot of 1 month high low. You get mostly prints above zero, just oscillating up and down, up and down, up and down. For the most part, you have more stocks printing 1 month highs than 1 month lows. And then last week it completely collapsed. Not a surprise. It happens. It just depends on whether we get somewhat of a recovery. You see what happened here is that as the market faded back, this was stuck under zero, and then even though so the market hit a higher high here and then a higher high here, but we got above zero here, which was nice, but then we got a much lower print there. So it's kind of a warning that even though we got back above to a new high, that this run to a new high just wasn't supported, and we came down hard after that. So from here, we're going to see just where we go. Okay, maybe we come up here and get rejected. Maybe we base down here, or maybe we come up above zero and then kind of back test zero and then go up from there. We don't know, but this indicator will definitely guide us and tell us what's going on beneath the surface. All right, here's same indicator. except we're using a 3-month high-low. So the 1 month, you can see, if the S&P is going to drop this much, then you could see a lot of stocks drop into a 1-month low. But here we have, the S&P just dropping 2 days, and we already have like 593 more stocks are printing 3-month lows than 3-month highs. That's a pretty big print down. So negative divergence followed by a big flush. We'll see what happens here. If it could recover, then the market will be in good shape. If it doesn't recover, then we're going to have some more downside and longer downside. So over here on the left side, you can see how we went below zero there. And then when the market was, when the market recovered, we got a little move above zero, but not much. You think if the market was in good shape over when it, new high here, you get an expansion up to here, an expansion, up to here, but didn't get very much above zero. So I told you that this push to a new high just was somewhat rejected here because we barely had a high low above zero. So we'll see what happens here. If we get rejected by zero and come down, it's, the market's going to stay down for a while. If we get above zero by a little bit, that's not good either. We need to push higher just to tell us that stocks are participating. All right, here is same indicator, but using 52-week high lows. The data is kind of compressed because of because of over here. But we get the lowest level since April, which is kind of amazing to me because, what's a 50? Is this a 52-week low here? That's got to be a 52-week low. The S&P is so far above its 52-week low, and yet as of Friday's close, we had 195 more stocks that were at a 52-week low versus a 52-week high. So that's not good. You can see what happened here. It happens, it happened there, but it was like this was after a couple months of sideways movement. So we'll see what happens here. We definitely were somewhat warned that that these pushes to a new high just weren't fully supported. The market was getting thinner. Now we have we have more stocks printing new lows than new highs. So we need improvement here. We need to get back above zero. We need more stocks at 52-week highs and 52-week lows. All right, couple more charts here. Here's the S&P 500 versus S&P stocks above their 20-day moving averages and 50-day moving averages. Both of them fell hard, closed at their lowest levels since April last week. Okay, you could see that the S&P itself fell below its 21. Okay, so this print doesn't entirely surprise us, but the S&P is still like that far above its 50, and yet you have more stocks below their 50 than above their 50. Okay, so internally the market is weaker than what the S&P would suggest. Okay, it's a little bit of a warning, so we'll see how things go. If this continues down, market's not going to recover. If we get a recovery above zero and can stay there, then the market will be in better shape. Like these indicators will tell us kind of what's going on beneath the surface. It'll tell us that if any move is rejected or embraced. Same indicator with the NASDAQ 100. So NASDAQ 100 is the 100 highest quality stocks within the NASDAQ. And you can see divergences here. Okay. So, market moves here, and we have like 85% of stocks above their 20, 80% of stocks above their 50. Then the market moves up even more, and then only 70% of stocks are above their 20, and only like 75, 72, 73, 74% of stocks are above their 50. So that last push higher had less participation, negative internal pressure building, and down the market came. And last one, this is the S&P 500 versus S&P, SPX stocks above their 200-day moving average. Just want to point this out because like during this entire uptrend, you can see that the stocks above their 200 just like oscillated between 60%, 80% and such. Okay, a lot of, definitely some 80% prints. And here we have this big rally, all-time high here. We've been at all-time highs for like 6-7 weeks, and yet we never got anywhere close to 80-85%. Okay, so this type of an indicator is longer term. It takes a while to play out, but it's a little bit of a warning that the market was pressing higher and higher and higher, and you couldn't get a high print up at 80-85%. All right, so overall, you can't say we weren't warned. Okay, we were warned. Okay, the internals had been declining for 2 to 3 weeks. The quality of our trading ideas had fallen off. Some stocks had started giving back gains. We were warned for a couple of weeks that the market probably was not going to be able to just relentlessly go forward, and down we came. It was pretty hard. We'll see what goes forward here. The internals will give us clues in the end. So the way I approach the market is that in a given year, I'm going to make a majority of my money in like 2 or 3 periods. There might be a 6-week period, an 8-week period, 3-week period, and all the profits I make for the year are going to be concentrated in those periods. So we're going to go through a period that's like really good for a couple months, and then we're going to go through a period which is like or pretty bad for several weeks or a couple months. And it's like the key to trading well is to recognize the market conditions and then align yourself with those, okay? Like trades that worked a month ago are not going to work today. They're just not. The market has changed, and you can't just keep forcing trades, okay? So we're in a period here where maybe we pull back a little bit and then in base and go back up. Maybe we fall even further. We don't know. I do know that trading right now is much harder than it was a month ago, so you have to make adjustments because of that. All right. Hope you got something out of this, and I will see you next time.